You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. As the federal deficit continues to grow, the need for elevated Treasury issuance has placed more attention on how the government brings its debt to the market and how to interpret the market's ability to absorb higher issuance. Structural aspects like ongoing balance sheet normalization from central banks are also helping shape the direction of longer-term rates. On today's episode, we talk with Peter Ryan, Managing Director and Head of International Capital Markets and Strategic Initiatives at SIFMA, about the day-to-day mechanics of the Treasury market, how to interpret Treasury auctions, and how rising federal deficits are shaping the longer-term bond market. We should note, for complete context, today's interview was recorded October 8th before last week's elections. Stay tuned. Coming up soon, our interview with Peter Ryan, but first, a quick market update. Donald Trump won the presidential election last week, and Republicans secured majorities in both the House and Senate. The bond market's reaction so far to the so-called red sweep has signaled expectations for higher deficits, higher growth, and slightly higher near-term inflation. Although the uncertainty about who will win the election has disappeared, there is still a wide range of possibilities when it comes to the specific policies Republicans choose to prioritize and enact beginning next year. Promises for tax cuts, curbs on illegal immigration, and widespread tariffs could have smaller impacts on the deficit, growth, and inflation if they're met with spending cuts and an easier path to legal work authorization. Also last week, the Fed cut the Fed funds rate by 25 basis points, as expected. The press conference was dominated by questions about how the Fed would respond to the election's macroeconomic implications and how Powell would deal with potential jawboning from President-elect Trump. Decisively underscoring the Fed's politically independent nature, Powell said the Fed will remain data-dependent and not speculate on potential policies or their impacts until they channel into the real economy. After he was asked if he would step down before his term ends or if the president has the legal authority to make such a request, Powell gave a firm no. The October CPI this week came in mostly as expected, rising 0.28% in the core to keep the year-on-year increase stubbornly high above 3%. The bond market initially rallied, relieved prices didn't accelerate more, but the long end of the Treasury curve continued to sell off. Yesterday's PPI points to upward rise in the core PCE deflator when it is released later this month. Fed funds futures suggested more confidence in a 25 basis point December rate cut after the report, though we think the November CPI will be a much more authoritative determinant of next month's decision. Despite all the recent significant macro events, yields in the policy-sensitive part of the Treasury curve have stayed within established trend channels going back to the middle of October. Bond investors are correctly focusing on the underlying macro fundamentals as determinants of near-term Fed policy rather than the electoral outcome. Two-year Treasury yields reached 4.35% this week for the first time since late July. Yields at the long end of the curve have struggled to find footing over the same time period, selling off initially after the election, but trading within relatively wide ranges since. Curve steepening has persisted through the choppy trading, but long-term yields may not calm down until the 2025 policy outlook becomes more clear. That's all for the market update this time. Now our discussion with Peter Ryan. Our guest today is Peter Ryan, Managing Director and Head of International Capital Markets and Strategic Initiatives at SIFMA. Peter, thanks for coming on the podcast.
Thanks for having me, Will.
Our topic today is the Treasury market, the mechanics behind the buying and selling of U.S. federal government debt, and how to read market signals in the face of rising budget deficits. So, Treasuries, as I know all of our listeners are well aware of, are the benchmark risk-free asset in our financial system. But what can drive those day-to-day movements and even the longer-term path of yields is not all that simple. To give some basic context, how much outstanding Treasury debt is there that is held by individuals or institutions that are not the U.S. government? Because, of course, the federal government itself holds some of those Treasury securities and weird accounting tricks. Also, the Fed holds some of it. All the institutions and individuals outside of that, how big of a market are we talking about? And as a share of the overall economy, how does this compare with the past?
Thanks again, as I said, for having me. The national debt at the end of 2023 stood at around $27 trillion when you exclude intergovernmental debt. So 71% of that was held by domestic creditors, and the largest share of that, 5.2 trillion, was held by the Federal Reserve System, a number that has been declining recently, and I'm sure we'll talk a little bit more about that. Another 1 trillion that was held by state and local governments, and then 13.2 trillion that was held by domestic creditors such as mutual funds, banks, pension funds, insurance companies, as well as individual household investors. And then the remaining 29%, or 7.9 trillion, was held by foreign creditors, 48% by foreign governments, and 52% by private foreign investors. So if you take those foreign and domestic private creditors, you get to about 17 trillion of US Treasury debt in private hands, or about 63% of the total. So it's a very big market that we're talking about. And it has changed over the last 25 years in particular. Treasury debt has grown fourfold in that period of time. So this has become a much bigger market. And as US government deficits continue to increase, it's only going to expand in the coming years.
So the need to increase the supply of Treasury securities comes primarily from budget deficits, which you just mentioned. The federal government spends more than it takes in the form of tax revenues, but the kinds of securities Treasury issues to meet those cash needs, basically the length of the maturities, whether they're tips or not, the timing of when they raise that cash, what's the process behind the scenes there?
In general, Treasury tends to issue securities with shorter maturities, such as T-bills and short-dated notes when it needs to raise cash quickly, as it did during, for example, the height of the Great Financial Crisis in 2008, when average maturities of Treasury issuance dipped to 48 months, and then again during the COVID-19 pandemic, when average maturities dipped down to 62 months for a period of time in 2020. By contrast, when there's less immediate need to raise funds and rates are low, the government tends to take advantage of that opportunity to lock in borrowing at lower rates for a longer period of time. So, for example, you'll see them issuing longer dated notes and bonds, with the latter obviously having maturities of more than 10 years. So, in May 2023, for example, after an extended period of low rates, the average maturity of US debt had risen to its highest duration over the last 20 years, reaching 75 months, as sort of some of that short term borrowing during the pandemic was replaced by longer term maturities. So that's typically what happens. Again, when the government needs to raise money quickly, they tend to go for a shorter maturity instrument. When rates are lower and there's less immediate needs, they tend to look to longer duration instruments like bonds.
I think you do see that in the data that those periods like the financial crisis or COVID, obviously a lot of tax revenue dries up because economic activity goes down, and also oftentimes there's some stimulus, and so they need money very quickly, and so bills seem to fill that void. But then between, let's say, a 2-year treasury, a 10-year treasury, a 30-year treasury, how does the Treasury decide, okay, here's what we think the supply should be issued in this security? Or do they just look for the cheapest rate and try to borrow under the most favorable costs, essentially?
They're looking for the lowest rate over the longest duration. And so that's what they're trying to maximize when they think about their issuance schedule. Again, if they can issue longer dated instruments at a lower rate, that's what they're going to prioritize. And again, if they need more immediate funds, as they did during those periods of stress, they'll again resort to the shorter duration notes.
In the early days of the pandemic, all of the uncertainty caused a lot of financial markets to freeze up. And as we've talked about before, the federal government was very quickly spending over $1 trillion of new money. And I have to imagine they didn't have the cash at the ready. So even though the Treasury market is this huge and liquid market, how did the Treasury market manage to adapt to these quick changes? Were there any issues? Were investors hesitant to go in and pour money into that new bill issuance, considering all the uncertainties? Or what happened? I think a recurring question that we have on this podcast for any topic is, what was your world like in March and April of 2020? So when it comes to the Treasury market, how adaptive was it to all the abrupt and uncertainty at that time?
Yeah, so back in March 2020, the Treasury markets experienced unprecedented volatility, and this is something from a policy perspective that we've spent a lot of time analyzing since that period. And initially the markets responded as we might expect. Yields on 1-year, 5-year, 10-year Treasury notes dropped significantly in the early days of March as investors sorted out safe haven assets. This type of yield decline was large, but consistent with past behavior during market crises. But then, as it became increasingly clear the economy was going to a full lockdown, yields on treasuries began to sharply increase as investors suddenly began to sell. There were many reasons for this. Many market participants needed to liquidate treasury positions to satisfy their demands for cash. This included mutual funds that needed to meet redemption demands from investors, brokers of investors that needed to meet clearinghouse margin calls, proprietary trading firms that needed to rebalance their portfolios or unwind trades, and foreign central banks that needed dollar cash liquidity to provide emergency support to their financial systems. And this broad-based sell-off of treasuries was part of what we now call the sport of dash for cash by investors. And it broke patterns of behavior witnessed in past crises. And at this point, banks and broker-dealers who traditionally play an important intermediation role in the treasury markets face balance sheet capacity constraints owing in large part to regulatory requirements, such as capital rules that banks face. And as a result, in many cases, they were unable to absorb the vast number of treasuries that were being sold by other market actors. And then others that provided liquidity during normal periods, such as proprietary trading firms, largely withdrew from the market. And you saw the depth of the market in terms of the quantity of liquidity declining rapidly, while bid-ask spreads widened, all suggesting that liquidity had evaporated. So that was a crisis moment in treasury markets, probably the deepest crisis, though not the only one that we've seen in the past decade or so. And then in order to stabilize the market, the Fed engaged in a series of interventions, including significant purchases of off-the-run treasuries, interventions in the repo market, and ultimately having an open-ended commitment to support the markets through the creation of emergency liquidity facilities. And they also granted some relief, a temporary relief that allowed bank dealers to expand their balance sheet capacity. So that restored the sort of normal functioning in the markets after that. But that was certainly an acute period of stress back in March and April of 2020.
Past that first stimulus bill, when the dust had relatively settled and we were all a little bit more sure of what the future would hold, there were still, within that first year of the pandemic, two major stimulus bills that totaled just about $5 trillion. And I look back to the stimulus right after the financial crisis, just under $800 billion, that people really thought the private debt market wouldn't be able to support. They wouldn't be able to absorb that much issuance. It was going to cause crowding out, which meant that public spending was going to come at the expense of lower private investment. But when we look back at that, the pandemic chapter, has the bond market been able to absorb this elevated issuance during the last few years? I mean, when you talk about the size of outstanding Treasury debt, that is a lot bigger than it was as of February 2020. Has the private market managed to absorb it? And where would we look to see distress if they had trouble absorbing all of that issuance?
No, you're absolutely right. First of all, the US government debt has increased dramatically. It's increased by 743% since 2000. And that average rate of Treasury borrowing has accelerated, as you pointed out, in recent years, given the pandemic-related programs that pushed up borrowing levels. Even in 2021, 2022, average debt issuance was 56% higher than it had been during the prior decade of 2010 to 2019. And then in 2023, borrowing levels were closer to 200% greater than they were in 2010 to 2019. And these trends are only likely to continue. You know, the Congressional Budget Office has estimates about the number of Treasury securities that it sees outstanding rising from 98% of US GDP to 107% in 2029. So that's a lot of debt that's being issued in a relatively short period of time. So far, the market, the private sector has been able to absorb this elevated issuance. There's still strong demand for mutual funds, pension funds, money market funds for Treasury debt. Households have been buying more Treasury debt as well. Demand at Treasury auctions and other indicators of market health have remained robust. And we can talk more about that. However, the public sector has been buying less Treasury debt. So the Fed has reduced its holding as it engages in quantitative tightening. And foreign central banks generally, with some exceptions, have been reducing their holdings as well. And banks have cut back their purchases owing to some of those regulatory capital constraints. So yes, they've been able to absorb the debt so far. I think the issue here is that households and corporates are more price sensitive than governments who are buying treasuries for policy reasons. So these private investors are generally going to demand higher yields at treasury auctions, a reflection of the elevated risks associated with treasuries as the size of the market grows, as well as macroeconomic conditions. So while the market is certainly absorbing the debt, I would argue that US government debt is likely to become more expensive to finance in the future. And there may also be an increase in volatility too, as these price sensitive buyers become a bigger portion of the market and are more likely to respond to changes in market conditions and economic data than some of the government purchases of debt that were previously more dominant in the marketplace.
I want to talk about central banks and private banks in just a sec, but really focus a little bit more on this concept of whether the private debt market is able to absorb elevated issuance. So, as I imagine it, if we were to see distress in the treasury market, if there wasn't enough demand to absorb all of that issuance, we would see it in the form of higher yields, right? Supply and
Right.
demand, it's a simple textbook thing where the price would have to go down for treasuries, which means the yield goes up, in order to attract enough buyers. But in that context, it feels uncontroversial right now to say that no matter how the November elections turn out, the current budget trajectory points to a lot more federal debt in the future. The 10-year yield is at just about 4% as we record this, which is a full 100 basis points lower than it was a year ago. And compared to the pre financial crisis bond environment, it's actually pretty comparable. So, why haven't interest rates reflected more concern over the current budget trajectory? 4% feels low if we really are in this scenario where there's going to be a doom loop of higher treasury issuance that's going to require even more borrowing to pay the interest. Why don't we see the concerns reflected in bond market pricing?
I think so far, it does seem that private sector and households in particular have been willing to purchase the debt. But I think various analysts have seen some indicators showing that yields are going up overall. I think that there are a variety of other indicators that might show that potentially that the yields will be increasing into the future.
I want to talk a little bit about treasury auctions and how they can be helpful in getting a kind of pulse check, engaging the market appetite for treasury debt. Every type of treasury security has auctions. I think bills are usually in the mornings Eastern time, and the coupon securities are in the afternoon in Eastern time. And this is the process by which they put the supply of treasuries to the market. And oftentimes that can cause market movements. In my experience, I've observed that on quiet market days or even days where there's a low level of trading, it can drive momentum in itself if an auction performs weak or strong. So, what are the different metrics to look at? How do you see treasury auctions in the context of the overall treasury market to see the supply and demand, how they're interacting?
As you mentioned, the primary measure for gauging investor demand is going to be the interest rate or yield that the Treasury pays to borrow at auctions. And I think that that's obviously the indicator that we need to be paying closest attention to in the coming years. Will be the most important in terms of giving us an indication of investor demand and many potential early warning signs of problems in the market. However, there are other metrics that analysts use. They will often describe an auction as weak when certain other measures fall short of their market expectations. One metric they use is the bid to cover ratio, which is the total amount of bids divided by the total amount of treasury debt offered for sale in a given auction. If the bid to cover ratio is lower than usual, then many analysts will describe demand for treasury debt in that auction as weak. While the bid to cover ratio at some auctions in recent years has been lower than expected, I think this indicator still suggests a set of robust demand from market participants. Another measure is the sort of when issued yield versus auction yield. So trading in new Treasury securities begins on a when issued basis as soon as an auction is announced, but before the auction is held. And then analysts will compare the yield in when issued trading with the yield set in the auction. And if the auction yield is higher, the auction is said to have tailed, and that is seen as indicating demand was weaker than anticipated. If the auction yield is lower, the auction is said to have traded through, indicating the demand was stronger than expected. This measure is quite volatile, so it's not always easy to see clear patterns in recent data, but that is another metric that analysts will use. And then the other metric that analysts watch for is who's buying this debt. One metric amongst others that tends to be followed is how much of this debt at auction is purchased by primary dealers. That's the 25 banks and broker-dealers that are expected to bid at all Treasury auctions at reasonably competitive prices and act as market makers in the secondary Treasury markets. If they're forced to buy more debt in an auction, that can be read as a sign of weaker demand amongst other types of investors, such as the corporates and households we just talked about. So those are some of the indicators, if we're just talking about auctions, that I think analysts tend to look at.
I think it's also worth pointing out that if an auction for a 10-year Treasury is, let's say, a Wednesday right before a CPI release, or if there's an auction the day before a Fed meeting, there's a lot of uncertainty about how that's going to change markets. So institutions might hold back from placing their bids because they don't want to be totally off in one direction. And of course, that can kind of clean a valuation of an auction performance. But it's still a helpful barometer, I think, of the market appetite for Treasury debt. So going back to something you mentioned earlier, central banks, both the Fed and foreign central banks. So the Fed has been reducing the size of its balance sheet for a while now. This means that they are letting securities roll off after maturity and not reinvesting in some of them, which means the bond market needs to absorb that supply. How has the Treasury market adjusted to the Fed's ongoing balance sheet reduction? I have to say, it's been so in the background during this Fed policy cycle, I think by design, but I don't see it popping up in many day-to-day analyses of Treasuries. And is this the whole point? Is that in kind of a big picture way, yields are a little bit higher than they would be otherwise? Or how do we look at how the Treasury market is adjusting to central banks rolling off these securities from their balance sheets?
I think my general take on this is that the market has been able to handle this because QT has been much smaller than the quantitative easing that the Fed had engaged in for really the prior 15 or so years prior to the latest round of QT. It's not trying to return its balance sheet back to those great financial crisis levels. And it's managed its reduction in its balance sheet in a fairly predictable and smooth way. And I think that that has allowed the markets to gradually, and I mean private sector actors, to gradually absorb more of the debt as you've seen that roll off of existing bond holdings on the Fed's balance sheet. And, as we've just discussed, demand has remained strong for mutual funds, money market funds, insurers, and households. Again, more price sensitive buyers than the Fed or foreign governments, but demand has remained strong. So I think generally speaking, that's why you've seen a relatively minimal level of disruption or impact on the markets thus far.
The way the Fed is set up, they kind of don't care what the prices they have to pay for these securities. I think private banks would like to pay the cheapest price they can find, but of course, because of regulations for capital requirements, sometimes they are more or less forced to buy treasuries at whatever the price is on the market. And so, in that sense of the regulatory regime, the regulatory environment, how have changes in capital requirements changed how the private sector is able to absorb treasury issuance?
Capital requirements are a big factor here. I mean, we talked about the growth in the size of treasury issuance. The other is that bank dealer balance sheets have become increasingly constrained as a result of the capital requirements that are being enacted in the wake of the financial crisis back in 2007, 2008. That has obviously constrained the ability of banks to purchase this debt, but it's also more generally, more importantly for the market and market functioning, affected their ability to intermediate in the markets. And that has potentially affected the depth and resiliency of those markets during periods of stress. And that's obviously something that's incredibly important to focus on as we think about ensuring resilient treasury markets moving forward. And those capital requirements are manifold. One that's received the most attention has been the supplementary leverage ratio. That creates essentially economic disincentives for bank dealers to hold low returning assets such as US Treasuries because it assigns them an equal risk weighting with far riskier and higher returning assets. And I think commentators from across the spectrum, people have different views on bank capital, do agree that it has placed constraints on the ability of bank dealers to play a role as market makers in the treasury markets. And that's in fact why US banking regulators decided to temporarily exclude treasuries from that SLR calculation during that pandemic-induced stress period in the March-April 2020 Dash for Cash episode. There are other capital measures that also constrain the ability of banks to engage in these markets and hold treasuries. But certainly the SLR is one of many that is playing a key role here. And then there are new proposals that the bank regulators have issued, such as the Basel III endgame proposal, that could further constrain the ability of banks to hold treasuries moving forward. So those are very important impact on the markets and on the ability of banks to play a key role in those markets.
I want to end with just a follow-up question on those Basel III endgame requirements. We had an episode earlier this year about it, but I think there was an update with, after some pushback from private institutions to some proposed policies. Where do things stand now in October of 2024 for changes in potential capital requirements going into next year? Will it depend on the election? Is the Fed going to do it no matter who wins in November? What should banks kind of think about for those capital requirements moving forward?
Well, let me just step back and say, what I just described in terms of bank constraints is only going to get worse if the Basel Endgame proposal, as currently proposed, were to be enacted. It would place significant constraints on their ability to act as market makers. Their balance sheet capacity would be diminished, particularly owing to something known as fundamental review of the trading book and the credit valuation adjustment portions of the proposal. And in particular, the way that they interact with the US stress tests, which all large banking organizations are subject to. So it will have a very big impact. Currently, the banking agencies are considering reproposing this rule. We don't know what the outcome of that process is going to be. There has been a delay in the issuing of this reproposal. So we have to wait and see what the content of that is. It certainly will be affected by the election. In the event that we have a change of administration, there could be a further delay in the proposal. And it could certainly be changes in the substance of what is being proposed. But again, we have to wait and see. There will have to be significant changes, though, in terms of the market risk components of the proposal in order to avoid, I think, some of the detrimental effects on the Treasury markets. And so we just have to wait and see once we see the text of the proposal, if and when it's issued.
Peter Ryan, thanks for coming on the podcast.
Thanks, Will.
That was Peter Ryan. I think what really sticks with me from that conversation is the number of factors that can drive bond market momentum that are unrelated to the macroeconomic data or the Fed's policy decisions of the Fed funds rate. Things like quantitative tightening, Treasury auctions, and even how the Treasury decides to finance its debt are important not only for the direction of longer-term bond market pricing, but also can help explain the day-to-day movements of Treasury yields. The next 2 weeks will be relatively quiet in the macro world, with the Thanksgiving holiday slowing down trading volumes before December. The October PCE report could give a more decisive signal on current inflation trends after this week's CPI showed inconclusive progress on getting inflation to 2%. The minutes from the Fed's November 7th meeting will also be released in a couple of weeks. Because there appeared to be little disagreement on the Fed's decision to cut 25 basis points at that meeting, and no new summary of economic projections was released, we don't expect those minutes to show any fireworks behind the scenes. Otherwise, investors will continue to keep an eye on President-elect Trump's cabinet appointments and public statements to get a better sense of what federal policy will look like starting next year in terms of fiscal plans, immigration enforcement, and regulation. The bond market could react from such announcements, but will likely wait until the legislative process rolls out before fully pricing in any changes. That's all for today's episode. Thanks again for listening. I'm Will Comperl, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.